Welcome back to the channel. I'm Foreman, and today I'm going to be talking about what is the best Vanguard fund to buy. And if you like this video and think it delivers more value than usual, then please drop one of these, as it does help out a lot, showing new people which videos are worth watching on my channel. So Vanguard is an investment broker in the UK that is well renowned for its low fees. Low fees and simplicity make a strong investment strategy for the longer term, so it's no surprise that Vanguard is very much a popular offering. However, new people that join the Vanguard platform may struggle to choose what fund they should invest in to best ensure that they can grow their assets over the longer term. So today I'm going to discuss what is the definitive best fund that Vanguard offers for a long-term investor. Now, firstly, it's worth understanding the difference between distribution and income. This is a term that you're going to see quite a bit over across some of these funds, and basically the difference is that distribution pays out dividend income into your cash position of your portfolio, and the accumulation funds reinvest that money back into the value of the fund so that it will appear in the price of the fund. Basically, if you plan to be completely hands-off and you don't plan on drawing an income for quite some time, then you'll likely want to choose accumulation, whereas if you're nearing the age of retirement and you'd like to have some income, then distribution is what you'd prefer instead. I should also note that there are a few funds on this and you may disagree with me, and if you disagree with me, definitely leave something in the comments down below. So firstly, on the offering is the Vanguard LifeStrategy. Now you'll see here, but slightly cropped off here, that you've got a range of percentage equities. Now LifeStrategy is basically aimed at an investor that wants an easy blend between stocks and bonds. They want to make that choice upfront and not have to worry about it again. And it has obviously that blend between your assets in the stock market, such as your stocks and shares or your equities, and also fixed income assets like bonds. Now, bonds aren't that great at the moment due to the lower interest rate environment. I know it's reaching more of a normality now, approaching 4%, but still, bonds over the longer term have historically underperformed stocks and shares. So if you've got a longer term investment horizon, it's typically considered a wiser idea to invest in stocks and shares, whereas if you're nearing retirement, you need to perhaps sell some of your positions soon, then bonds are the more approached method. Now, the diversified nature means that anyone could own a LifeStrategy fund, whether you're young or nearing retirement. So if you were younger, perhaps you'd be leaning towards the 100% equity fund, which could be more advantageous for you. Whereas if you're older, perhaps you'll be leaning more to the 40% equity fund. Now, the fees are at 0.22%, which is quite good. The yield is 1.84%, which is paid out annually as distribution. However, one of the downsides of the LifeStrategy fund, we're looking at the 80% equity here, is that they have an abnormally high exposure to the UK, meaning that they're overexposed to the UK stock market, which isn't a good global representation, whereas actually a majority of the stock market is exposed to the United States and other locations, and the UK does not make up as large of a share as it does in this fund. However, it's likely incorporated as we're in the UK, we're likely going to have some form of a nationalistic bias, and therefore we might have more of a reason to purchase it. That can be a downside, especially when you consider that the UK economy, I know the economy is not the stock market here, but the UK is typically underperformed, especially following Brexit, so it could be a concern for you as an investor that wants global diversification, and you're limited by the UK being picked here. Now, the way LifeStrategy is built may be enticing for investors to go, you know what, I'm interested in purchasing this fund, I'm going to get myself a LifeStrategy 100 fund and a LifeStrategy 20%, or, an 80%, so I've got 90% equities and 10% buy. It's kind of a waste of time, it's not really worth it, but the way it's built kind of incentivizes you to buy multiple different ones, which doesn't really achieve much at all, if at all anything. If anything, stick with one and go for it for the longer term. There's certainly far worse funds out there. Now, the next fund on the list is actually Target retirement funds. Now, I like these. You can see how they change based on the year. So you select a year that you'd like to retire, and that's it. That's the fund that you'll do. And they're quite clever, and I like these because the target retirement funds automatically adjust the exposure between stocks and shares and that of fixed income assets such as bonds. So as you nearer the retirement date, it fixes more into fixed income assets where you'd be more likely to looking to draw an income. So let's look at, for instance, the 2020 fund, which is now passed by 3 years. You can see that a majority of the assets in this portfolio are actually bonds. Therefore, you're going to have less volatility, hopefully, in the portfolio, and more income that's more stability, really. As you're retired, you want more stability and less volatility to preserve your wealth. Whereas when you're younger and you're looking to retire for longer term, you're going to want more volatility, the chance to buy more and accumulate more over the longer term with stocks and shares. And the brilliant part about this is there's not much effort required at all. You pick a year that you'd like to retire and you contribute to it. The ongoing charge is slightly higher than Lifestrategy Funds, coming at 0.24%, and the yield is 1.38%. However, I should note here that the only option for the retirement funds, and this may change once you've reached that year, although it doesn't appear in recent funds or in the ones of 2020 or 2015, is that they're accumulation only. So the dividends are reinvested automatically, which may change as you reach that retirement age and are in drawdown, but that could be a concern for someone that would like to reinvest that elsewhere. But it will likely push on, and it's worthwhile noting. That said, there's also, even with a retirement date of 2060, you're still exposed to 20% bonds, which I don't necessarily think is good for long-term growth. You've got 37 years here. 37 years is an adequate period to really be invested long in stocks and shares, and I really wouldn't want to have 20% bonds at such an early stage. I'd like to push maybe more or less to 15 years is maybe when I'd start considering bonds, not 37. So I do feel that it would underperform the typical markets and may not be advantageous in that regard. Next on the list is quite a popular fund here, and it is the FTSE All World High Dividend Fund. Now, this is popular because people love their dividends. This one comes in at a slightly higher ongoing charge of 0.29%. Now, this is made up of stocks that pay high levels of dividends. So we look at the portfolio data here. You'll know some, widely known companies. We've got the likes of we've got the likes of Exxon, we've got JP Morgan Chase, we've got AbbVie, Pfizer, Nestle, Home Depot, there's likes of Coca-Cola, Pepsi, need I go on. So these are companies that have a high dividend yield. Now this is a higher than average paying fund, obviously, because it's seeking high dividends, where you're looking at basically a yield of about 3.56%, and the distribution frequency is quarterly, which is quite nice, meaning you're getting that quarterly distribution, which is great. The ticker for this is VHYL. However, as I said before, the fees are slightly higher than the rest, although certainly not bad, especially for Vanguards. I would note that because of the name high dividend, right, it's not really going to be investing in growth assets. As I showed you before with the portfolio data, basically you're not really investing in high growth names. You're investing in businesses that do better for shareholders by reinvesting their cash flows, by using their cash flows and paying it as a dividend. The surplus cash flow, they can't use it to reinvest back in their own business. Shell, Exxon are massive businesses already that are extremely profitable. They're not going to make too much by reinvesting in themselves, so instead they'll distribute it as a dividend, as income to shareholders, which therefore means you might not see as much capital growth as you would with some of the other funds on this list, but as I say, you make up for that with that 3.6% dividend yield. Next on the list is a very similar fund, and personally, one of my favorites on the list, and this is the FTSE All World ETF, or the ticker VWRL. This is not to be confused with the High Dividend Fund. This tracks the global stock market, like the Dividend Fund, but without the bias towards ones paying higher dividends. This means you've got a mixture of growth stocks and also dividend stocks, which is where the yield comes in at 1.92% here. So certainly not on the high end, but it's also paying quarterly. But when you look actually at the companies held here in the portfolio data, you've got a much more realistic blend. Obviously, the US is dominating at the moment, so you've got a very high exposure of 58.5% to North America, and the United Kingdom is at 4.1%, which removes the UK bias that the Lifestrategy and I also believe the target retirement funds have. And when you look at the top held companies, these are some of the biggest companies in the world. Apple, Microsoft, Alphabet, which owns Google. You're owning the big businesses, the businesses that are really dominant. You've got Johnson & Johnson, companies that are not going away anytime soon. And whilst the majority of it is invested in the United States stock market, these are globally diverse businesses that are very much dominant across the world and are likely good companies to hold on to. And it has good global stock market exposure without UK bias, although realistically, whilst the fees are in line with the other funds in this list of 0.22%, I do think you can do better. And actually, my favorite on this list is a little bit further down. Now, this isn't by all means globally diversified across stock markets, but it's certainly my favorite fund on the list, and this is because it has the lowest fees but also widest investment range, and this is the S&P 500 ETF. We can see here that the S&P 500 has a yield of 1.34%, but the fees are really good because your ongoing charge is 0.07%. Now this is by far much cheaper than some of Vanguard's other offerings. This is basically a very minimal fee, and it's good to reduce fees in your portfolios because this eats into your returns. The S&P 500 is the largest 500 companies listed in the United States. Again, you've got your Apple, you've got your Amazon, you've got your Google, right? Big businesses, but just the United States markets. They've got globally diversified revenue streams, and it would really be challenging to find a lower cost fund anywhere else, I'll be honest with you, unless it is the S&P 500 offered by the likes of, let's say, iShares, for instance. It's a low fund fee, it's a globally diverse fund, and it's also got that almost greater exposure to the stock market that I'm interested in. There's some markets where I'd like, you know what, I don't want to be invested in this place. This one has a very good blend of that, and that's why I really like the S&P 500. After all, over a 30-year period, on average, the S&P 500 has returned about 8% per year. This is the benchmark, effectively, and this is something I think is good. You've minimized the fees, you've got good global diversification, and it really makes sense as an investor. But perhaps that's because I'm a stock market. And as I say, the pro is also a con. It's only exposed to the US markets, which has historically outperformed, but it may not continue to have its outperformance. The United States may slip back, but I think that's unlikely because I think these companies are dominant for a reason. And as I said before, the companies are globally diverse and generate revenue across the globe. So I'd like to know, what is your favorite fund, or what fund do you think is the best to invest in the Vanguard platform? I'm personally a big fan of the S&P 500, but closely followed by the likes of the FTSE All World if you're after that global diversification. If you've not done so already, don't forget to subscribe for more investing and finance channel related content. Have a fantastic day.